Hi, this is Tom Wheelwright, founder and CEO of Wealthability, where we're always discovering how to make way more money and pay way less taxes. So in this video that you're about to watch, we did a town hall on the new stimulus package. What we also did was we took a lot of questions, and most of them I knew the answer to, but there were two that I wasn't sure of and I wanted to double check on. So we put those answers into this video and we hope you find them and enjoy them. Welcome everyone to Wealthability Town Hall. My name is Tom Wheelwright, founder and CEO of Wealthability. We are always discovering how to make way more money and pay way less taxes. Thanks so much for being here, for joining us in this very tumultuous time in the United States. Certainly, I've never seen anything like this during my time, and I'm probably older than most of you. So let me tell you a little bit about what we want to do here and why we want to do it. This is very informal. We discovered when we did a town hall like this for the CARES Act, there was so much confusion around it. And we thought, well, there's enough confusion going on right now between the new stimulus package and the new administration. And now we have a Democrat-controlled Congress, not just the House, but also controlling the Senate, as well as the White House. So what do we expect there from a tax and economic standpoint? So, you know, this is just our goal is to serve you any way we can, really to provide the education and information that is hopefully unbiased. It's intended to be unbiased and just the facts, they used to say on Dragnet many years ago, just the facts. So where are we right now? So we thought we were at the height of the pandemic in May. It turns out we're at the height of the pandemic in January. We have had 4 million businesses go under in the last 9 months. 4 million businesses that are never going to open again. We have every other business is skeptical, except probably Amazon and, you know, Walmart and a few others, Tesla. They think they're good, but any small business, there is no guarantee that anybody who's a small business owner that's on this call tonight will be here a year from now, us included. I mean, there are no guarantees right now. So we have a pandemic. We've got this vaccine that's not rolling out. In Phoenix, they opened it up and we got 4,000 shots today. So it's just a challenging time from an economic standpoint, as well as from a health standpoint. We're going to focus on economics here. And then there's the big question about, okay, so what do I do about this? We have lots of people unemployed, hoping for a continuation again of additional unemployment benefits. We have businesses that are struggling. We have shutdowns happening. We have people who are just afraid of going out. We have potential challenges with the inauguration and what kind of disruption is that going to cause? People are going to cause there. So there's just a lot going on. So the first question is that I want to address is what to do. Okay, who's winning and who's losing? And the people who are winning are the people who are adapting, frankly. The people who are being successful are adapting. I have a number of clients that had their biggest year ever last year, okay? And they expect an even bigger year this year. They're adapting. There are other people that are not, and they're being left behind. So what does that mean to adapt? Well, the very first thing, remember, is we are all about entrepreneurship at Wealthability. We're about you taking control of your life, about you taking control of your financial situation. Let's not be relying on the government. Let's not be relying on other people. Let's not even be relying on employers. And I say that as an employer, okay? We have to take responsibility for ourselves. I was very fortunate to grow up in a mother and father who were entrepreneurs. My grandfather was an entrepreneur. My great-grandfather was an entrepreneur. So it's in my blood, so to speak. And I truly believe that entrepreneurship is the way forward. You know, entrepreneurs are all about practicalities. How do we serve more people? That's our goal as entrepreneurs. How do we serve more people? However, we're going to serve them. Now, we're all unique. We're all unique in the way we serve people. So I know my good friend Kim Butler is on this webinar tonight. And Kim taught me a long time ago. Now, Kim is really one of the great life insurance experts in our time. And Kim taught me, you know what? There's enough business to go around. And there truly is, because the people that come to you are going to be different. You have a unique style, a unique ability that is different from any of your competitors. So as long as we're adapting to the environment and that we're doing what our customers want, we're going to be successful. Well, here's the great news. And any of you have read my book, Tax-Free Wealth, listen to my the Wealthability show, the Wealthability podcast, know that, you know, the tax law very much favors the entrepreneur. It very much favors business. And the reason for that, of course, is the tax law is promoting, the government is promoting what we do. They're promoting technology, they're promoting innovation, they're promoting jobs, okay, creating jobs. They're promoting, you know, all of the positive energy that comes from entrepreneurship. Think just this way, okay? Most of us are sitting in our home office right now. Employees are not deducting the home office, and entrepreneurs are. So that's just a very simple example of where entrepreneurship is favored in the tax law. Now, I'm not passing a judgment on that. I personally will. Well, I take that back. I will pass judgment on that. I think it's great, because I think we need more entrepreneurship. I think it's entrepreneurship that really gives us the energy that we need in this world today. And it's not to say that you're bad if you're an employee. That's great. I mean, I love employees. I have lots of employees and I think they're amazing. Okay. I'm just saying that if you really want to take advantage of the tax law, if you really want to take advantage of the current climate, I mean, think about this. We have more people online than ever before. It has never been this easy to start a business, ever. It's never been this easy to be successful in a business. Not only do we have tools that are practically free, okay? I mean, we're on a meeting right now that is not very expensive, right? A lot of information is free, but on top of that, we have customers that are being given money from the government, okay, to spend, and the government wants them to spend it, right? So there's no reason we shouldn't be successful right now. There's absolutely no reason at all. We just have to adapt, get educated, and take responsibility for ourselves and help others. Okay, I think one of the big things that we're lacking right now is maybe a little bit of compassion. One of my goals for the year, when I did my New Year's resolutions, was compassion, because I think that is something that we could use more of. I find entrepreneurs as a group to be extraordinarily compassionate and willing to give of themselves and share with other people. So, little plug for entrepreneurship, little plug for entrepreneur. I also, by the way, plug Entrepreneur Magazine. I'm a regular columnist in Entrepreneur Magazine. So big fan of the whole idea of starting a business, creating jobs, and taking charge of your own life. So what do we see? First of all, let's talk a little bit about what this new stimulus package, okay? There were a lot of things in the stimulus package, and to unpack it, I mean, it was actually part of the budget bill, right? So it's, hundreds, thousands of pages long. There were some key items in there. Obviously, we got the unemployment extended, the $300 a week unemployment extended. A couple other things that were really nice. Those of you who are own multifamily, any kind of housing, there is relief in there for tenants. And you're allowed and encouraged as a landlord to help them apply. Okay, there are very strict rules on it. They have to meet certain qualifications, income qualifications, but I do think that that is something don't ignore. It's not something that applies to a lot of people, but it applies to a lot of tenants. So not a lot of entrepreneurs, but a lot of tenants. And so if you do have tenants who are struggling, don't forget that that's available there. There are really three big things for business owners though. And the very first one is more PPP, okay? And Paycheck Protection Program. And you really have lots of opportunities here. First of all, not taxable. So not only is this PPP loan not taxable, your previous PPP loan is not taxable. The expenses are fully deductible. That was made clear. So whether you qualify for this new one or you just had the old one or both, the expenses qualify to be deducted and the income is not, when it's forgiven, that forgiveness is not taxable. Otherwise, it would normally be taxable. It is not taxable because of the way the law is written, okay? So no tax. Second of all, we have a second loan. And I really want to emphasize the second loan. Before I go into how it's calculated and who qualifies, there's been a disturbing effort, in my mind, to shame people into not taking out the PPP loan. We saw it in the first round. Big companies were shamed in not taking it. Ruth's Chris, one of my favorite restaurant chains, shamed into not taking it. They gave it back. Okay, now bless their heart, good for them that they were able to do that. This is a restaurant chain that shut down for months and months and months. So would not have bothered me that they had it. Now, what's going on now? One of the requirements when you sign up for your PPP loan is you have to say, look, due to economic uncertainty, the economic situation right now, I need this loan. Okay, it's just an affirmation that you need this loan due to economic uncertainty. Let me tell you something, and this is obviously my opinion. Everybody who qualifies needs this. Just because you have cash in the bank doesn't mean you're going to have cash in the bank. Okay, what happens if half your staff comes down with COVID-19? What happens if the government decides you're not an essential service? I was fortunate. My CPA firm has always been considered an essential service. Some of our people need to be in the office. They do. That's been important for us. So we're fortunate. Now, what if they said, well, guess what? Not essential anymore. You're shut down. We're going to need cash. And one of the first things I learned as a young business owner, I was probably in business 3 years, probably my third year in business. And I had a client actually asked me to work for one of his partners. And his partner had a convenience store and wanted me to do some analysis. And we did some analysis. It turned out to be pretty messy. And so the client came back to me, my client, and said, I know it's not my bill, but I'll send you some money. And I was being magnanimous and I said, no, I'll get it from them. It's their bill. I never saw the money. So here's the lesson I learned. Never turn down cash. And I'm dead serious about that. We are in extraordinarily uncertain times. And you want to turn it down, that's your choice. I'm saying that you want business, business advice. My business advice is right now that I would be heavy in cash right now. And if there's an opportunity for cash, and I would tend to take it. Okay, so what does the second loan? Who qualifies for the second loan? It's not just anybody under 500 employees. Okay, first of all, 300 employees is the number, not 500 this time. 300 employees. This is the second round. Now, by the way, if you're applying for the first time, it's still 500. So you can still apply if it's your first loan. But if it's your second loan, it's 300. Okay? It's 300 employees, and this 25% is a big number, and here's what that means. You're going to look at every quarter of 2019 and compare it to the same quarter in 2020. So first quarter of 19 to first quarter of 20, second quarter of 19 to second quarter of 20. In my CPA firm, we just sent our clients a spreadsheet and said, fill this out. And if one of the numbers comes out to be 25% or more, then you qualify. So any one quarter. So let's say, for example, that your first quarter was fine. Your first quarter is fine. Now it's your second quarter. Your second quarter of 2020 got hit hard. And so it's lower by more than 25% than the second quarter of 2019. Let's say third quarter was back up. Fourth quarter was fine. End of the year, fourth quarter was good. And let's say overall that you were the same in 2020 as you were in 2019, as an example. You still qualify for this loan. You still qualify for the loan. How much is the loan? It's the same as the other one. It's 2.5 months of salary. So 2.5 months of your average salary, computed just like it was the first time under the CARES Act. 2.5 months is what you're going to be able to borrow. So if your payroll is $100,000 a month, it's roughly going to be $250,000. Okay, so it's 2.5 months of payroll. Now, how do you have to use that? It's actually broader now than it was under the original CARES Act. So remember, under the original CARES Act, well, we had changes in the laws, we went along, but what we ended up with was 60% had to be used for salaries, and 40% could be used for other things such as rent and utilities. Okay, they've added some more things like personal protective equipment, a couple of other repair damage that was done, for example, in the riots this summer. That qualifies. So other things, there's a list of things that qualify, and I'm going to let you go to your CPA and ask them for that list if you're concerned about using it up. Now, the reality is you have up to 24 weeks to use this. So from the date you get the loan, you have 24 weeks to use that up. Well, consider you only got 10 weeks. If you've got even half the employees that you had the year before in 2019, if you have even half the employees that you had, then you're going to use it up in just payroll. So just remember that. You're still going to be able to use it up. There are other computations. You still have to meet the other computations. You have to have the employees there. You have to, all those things apply still. So make sure that you sit down with your CPA. This is where a good CPA is just going to be worth its weight in their weight in PPP. Truly, because you're going to walk through all of those rules, then they can help you apply for forgiveness. Now, one of the questions I get a lot is, should we apply for forgiveness now of the old PPP loan? Absolutely. Absolutely. Apply for it. Take care of that while you're applying for the new PPP loan. You don't have to, don't wait. Don't put it off. Just go ahead. All right. Now, just one more thing on the on this loan is I just want to emphasize, I know I don't want to beat a dead horse, but I want to emphasize that this, the government is giving us a lifeline here. And now on the one hand, don't just, you know, if you think you're going out of business, don't be, you know, it's better to cut your employees. Okay, it truly is. Okay, the biggest mistake that people made in 2007, 2008, 2009 is not cutting their staff quickly enough. Now, you may find I need to cut back on my salaries, I need to cut back on my staff, and then I'm going to, you know, bring them back up. You can do that too. Under this new PPP loan, the time frame is 24 weeks, but you can choose any time in between there. So anything from 8 to 24 weeks, you can choose any of those, any of that time frame for this new loan. So in the old loan, it was 8 weeks or 24 weeks. In the new loan, it's anything in between, anything from 8 weeks to 24 weeks. Once you use it up, go ahead and apply for forgiveness. Okay, you're done. So you kind of want to manage that because you have to have, you know, where's your level of employment? You know, at what level you want to make sure you're at your highest level of employment when you cut your time off. So there are some little details that to follow. Let me be clear. There are some details to pay attention to in this new PPP loan. So again, sit down with your CPA. Every CPA I know is just ready and willing to help and serve any way they can. The good news is it's early in tax season, so we have a little time and we're available. Okay, I will tell you, we as a profession, we are readily available to you to help you with your PPP loan applications and your forgiveness applications. Okay, Manny, I'm going to go ahead and open it up right now for questions on this before I go on to the next subject. Any questions that you have on PPP, on the new PPP loans, on the old PPP loans, anything that I can respond to? Manny, anybody?
Sure. One question that we have from an anonymous attendee, they thank you for doing the webinar, and they say, can an S Corp apply for a second draw PPP loan if its payroll is based on leased employees from a professional employer organization?
Yes, as long as it's payroll. Okay, so it is payroll. They are employees. You may be using the PEO. That's a professional employment organization. You may be using them, but they're really your employees. Just because the PEO files the 941s, the payroll tax reports. We, for example, at Wealthability, we use a PEO. Okay, I don't do my own payroll. Okay, we use a PEO, and they will provide you with the reports. Actually, they're very good with the reports. They've been very good. As a general rule, all of them have been very good with the reports on the for the PPP loans, and they'll provide you with the information that you need as a general rule. So I would go to them and say, okay, tell me what you need in order to get the information that I need to submit for this PPP loan. Now, I will say that if your loan request is under $150,000, you actually don't have to submit any documentation. Okay, if your loan request is under $150,000, then you do not have to submit any documentation in your request. You just have to say, I have the documentation. I'm saying that I need this loan. I'm saying that I qualify for this loan, and I'm saying that this is not more than 2.5 months of salary. So you're just signing an affidavit basically if you're under 150,000. And the same will be true when you apply for forgiveness for that loan. They will just ask you to sign off, and they're saying, look, you're signing off, and you're good to go. They have the right to audit you, of course, but they're requiring less documentation for under 150,000. If you're more than 150,000, which by the way, you can go all the way up to 2 million on this loan. The last one was 5. This one is 2. You can go all the way up to $2 million of a loan, up to 2.5 months of salary. So you'll just need to go to your PEO and get that documentation.
Great, thanks, Tom. Question that we're getting from Facebook is, what would the 25% decrease comparison to qualify for PPP round 2 for a business that started ops in 2020? This question is from Sandra.
So let's look at this 25% rule. Question is it 25% of gross income or gross receipts? Now, what we have to do is we really start to have to understand the difference between gross receipts and gross income. Gross receipts is money, okay? So this is actual dollars that have come in the door. That's gross receipts. Versus gross income. So what's the difference? Why isn't gross income always gross receipts? Because sometimes we have a customer who will pay us later. So let's say, for example, that we're looking at second quarter of 2020 versus second quarter 2019. Well, we may have billed customers at the end of June, right? At the end of June, at the end of the quarter, that didn't pay us until the next quarter. The requirement in the new stimulus bill for that second PPP loan is that your gross receipts has gone down by 25% quarter by quarter. It's gross receipts, not gross income.
We have another question internally, and Michael says, thank you for the information. What documentation will be required to verify the 25% plus decrease in revenue in a quarter?
You know what? You just have to assert that. If you were audited, you'd have to prove that. Okay. But I would just complete the application. Your documentation is really about the 2.5 months. That's the documentation you're submitting. So I would just, whatever your bank tells you, remember, these are loans that are provided by your bank. So not every bank's going to be exactly the same. So give them the documentation they're asking for. Okay, whatever documentation your bank asks for, give them that documentation. But truly, I mean, you're looking at your books. I mean, if you're in QuickBooks, for example, or Xero, or some other general ledger package, all you're looking at is, I would just do a report for each quarter. Okay, each quarter meaning January through March, April through June, July through September, and October through December. And I would just do that comparison. Okay, and then if they ever ask you for that, or if the bank asks you for that, you can submit that.
Another question from Facebook is, as a small business LLC flow-through entrepreneur, do I qualify? Yes,
you do. Okay, this is similar to the first go around, where you do qualify for the PPP loan, even though it's your salary. It could just be yours. Okay, so that's okay if it's just you. Just know that they're really trying to keep businesses afloat, even independent contractors and single member businesses. That you're the only employee. They're still trying to keep you afloat. Okay, so let me move on for now to the next, a couple of tax issues that came up, a couple of tax issues that have come up during in this new stimulus bill. Okay, one of them I love. Okay, and love him or hate him, this is a direct result of President Trump. And that is 100% meal deduction. Okay. Now, here's the great thing. even if it's takeout. So what is required for a meal to be deductible? Okay, there are 4 requirements for a meal to be deductible, and those 4 are still going to be required. Okay, number 1, is you have to have a business purpose for that meal. So you can't just go, you just can't go, you know, get a meal from your favorite restaurant, bring it back home and eat it with your spouse. And, you know, you're just talking about your day. There's got to be a business purpose to it. Okay. Number 2. It has to be ordinary. That means typical, meaning it is a business meal that you would typically do. So what does that mean as far as, you know, when you talk takeout? Well, let's say that you get takeout and then you do a social distancing dinner with colleagues. Okay. You sit around your backyard and you have you have a team meeting. That would be ordinary. Okay. It's an unordinary time, and it's an unusual way to do it, but to have a business, a meal while you're having a business discussion is not unusual. Okay. So it has to be typical as to amount and frequency. So, you know, don't go crazy on the, you know, on the $300 bottle of wine, unless that would be typical in your industry or in your situation. Okay. This is good for the next 2 years, 2021 and 2022. It's going to be fully deductible. So this is actually a pretty big deal for a lot of people. The next rule. It has to be necessary. And that means that the purpose of the meal, of the expense, this is true for any expense, but the purpose of the expense is to increase your profit or your profitability. So again, you're having some kind of a meeting with a business associate, some kind of meeting with a potential client or a current client, or some type of thing that you go, you know what, if I have this meal with them, this is going to be a good thing for my business. It's going to increase my profitability, or it's going to increase my market share, for example. Number 4. It must be documented. Okay, so you still need that receipt. You still need to write on the receipt who you were having dinner with, the purpose of what you discussed. Okay, and then all the rest of the information actually is on the receipt itself. Scan the receipt, put it into your software, put it in your filing system, whatever. Know that you need to have that so that you can, you know, if you're ever audited, you can provide that information to the auditor. Now, here's just a thought for you. Okay, I know. So I know that we often, when we have a significant other, spouse, significant other, that we are frequently talking business with that spouse or significant other, even if they have no involvement in our business. So could you meet these tests with a spouse that is you're accountant and they're a musician. I had a spouse that was a musician. Okay. Could you meet that test? Absolutely. Now, could you meet it every day of the week? No, because it's not going to be ordinary. That's not going to be typical. Could you have a business meeting with your spouse once a week? I don't know how the IRS would even argue that, as long as you document, here's what we talked about. This is why we had this business meal. So what that means is that you're doing all this carry out right now. Okay, just because it's carry out doesn't mean it's not deductible. And that's the message I want to get across. Just because it's carry out doesn't mean it's not deductible. Okay, The other tax issue that came up. First of all, Manny, any questions about the meals?
I don't see any questions about the meals, but we do have someone that raised their hand around this same topic. So I'm not sure if his question will be about meals, but we can try it.
Well, let's open it up.
Okay. So Bruce, you're allowed to talk. All you need to do is unmute yourself and you should be able to ask your question to Tom.
Hey, Tom, thanks again for all of your wonderful wealth of information.
Absolutely, Bruce.
My question was, is it the business income needs to be down 25%, or was it payroll specific?
It's business income. So it's gross receipts. So this is your very top number that has gone down. Now, let me give you an example. I have a client that their expenses dropped precipitously. It's an odd situation. Their expenses came way down, okay? And their income came down. They're going to qualify even though their net income was higher than it was the previous year. They qualify. They absolutely clearly qualify because it's not net income we're looking at. It's gross income. All they're looking at is, were your sales damaged by 25% or more in any quarter? All right.
Great. We have another question from Alec. He's a photographer with an LLC. If he's on a 5-day week road trip, can he deduct every meal from the trip?
Yes, thank you very much. So travel, that's meals traveling away from home, and that is awesome because now for the next 2 years, when we do that travel, we're not going to limit it to 50% deductibility like we were in 2020 and before. And really for as long as I can remember, we were at 50%. It changed many, many, many years ago. Now it's 100% for two years. And yes, you're going to be able to take 100% of your meals as a deduction for the next 2 years while you're traveling away from home for business. Now, what's the rule on traveling for business? There's also, remember, your travel is also deductible. Well, what makes it deductible? There's an additional rule for travel, and that is that you need to be spending you need to be spending more than 50% of your day doing business. Now, we look at business day as an 8-hour day. That is the common business day for most people. Now, not most entrepreneurs, but most people, that's 8 hours considered a business day. So if you spend 4.5 hours on business, you can do whatever you want. The other 19.5 hours. Okay, just be clear. And it's still deductible travel. And when you get deductible travel, you get deductible meals to go along with it. Thanks for that question.
And we have some questions in the Q&A part. Someone's asking, only 50% of meals is deductible? And then the other question related to that is, does the 100% deduction apply to entertainment, or is entertainment deduction still not allowed?
Okay, thank you for that question. Entertainment is not deductible, only meals. And meals are deductible at 100%. So last year, meals were deductible at 50%. This year and next year, they're deductible at 100%.
We have another question from Facebook. On a construction site, I typically buy lunch for the crew. Does that count as a deductible meal?
Yeah, it does, because you're keeping them there for your convenience, and that's going to still be a deductible meal to you.
And one other question is, all meals are 100% deductible, either take in or take out?
Correct. Eat in or take out, it's still 100% deductible. Yeah. So, like I said, is there one more there, man?
Yeah, one more if you don't mind. A corporation files its tax return on cash basis, and its cash receipts decrease less than 25% in each quarter of 2020 from the same quarter in 2019. However, its billings for Q2 of 2020 decreased over 25% from its 2019. Can they still qualify for the loan?
Yes, so long as you started by February 15th of 2020. As long as you started your business by February 15th of 2020, you can still qualify for the PPP loans. Now, what if you started February 1st? Well, you don't have a 2019 to compare to. So what do you have to do? You have to compare to other quarters. So in this case, what you're going to do is you're going to compare first quarter versus the second through the fourth quarter. You're going to compare the first quarter to the second to the fourth quarter. So if your gross receipts went down from the first quarter to the second quarter by 25%, okay, but by more than 25%, excuse me, by more than 25%, then you qualify. Again, you still have to certify that you need this loan because of the economic uncertainty of the times. That's a pretty easy question to answer. Most people do, but you still need to certify that. On top of that, you need to meet the 25% test. In this case, the answer to your question would be you just have to be in business by February 15th of 2020 and seen a decrease through the year, basically. Okay, as a result, basically they're looking at as a result of the pandemic. By the way, you don't have to prove that it was as a result of the pandemic. It could be for mismanagement. It could be for any reason that you saw a decrease of the income.
When does the 100% meals expire, and can it be reversed with a new tax law change?
So anything can be reversed with new tax law change. Okay, I'm going to get to that next. We're going to talk about the Biden tax plan. That's the next part of this discussion. It expires at the end of 2022. So 2 full calendar years is when it's allowable. It expires at the end of 2022, December 31st, 2022. Could it be extended? Absolutely could it be extended. I would not expect it to be extended. I wouldn't. The only reason it's in there is because President Trump insisted on it. That was his do or die. He really wanted that. I think it's a great provision. I think policy-wise, it's a great provision. You think about how many restaurants and how restaurants are struggling. This should help. It really should help. Taxes do provide an incentive. The tax law is a series of incentives, and taxes do provide an incentive, and people do pay attention to it. Just, the number of people we have on this event, on this call, is a good testament to that. Taxes matter. So could it be changed? It could. I can't imagine it changing in the next years. I would just be shocked. Could they extend it? They might. Who knows? But I would just plan on it for the next 2 years. Okay, I'm going to go one more thing. One more thing that they extended another year. And I have to admit, I also think this is a great policy. Okay. And that is charitable. Donations. The normal rule is you can only deduct up to 60% of your income. So if you make $100,000, you could give away $60,000 and that would be it. If you gave away $80,000, you still only get to deduct $60,000. Okay, the rest you'd get the next year. For 2020, remember the CARES Act made that 100%. Now this is 100% for 2020 through 2021. Now, will there be a lot of people that hit that 100%? Probably not. But the people I can see hitting it are people who maybe have investment income, and maybe they have some non-taxable income. So they give away a lot. They give a lot of the amount of that they give away is maybe more than 60%, and they're going to get 100% deduction. I love that. I love that policy. That's one I would love to see them make permanent. what's wrong with paying zero tax if you're giving it all away to qualified charities? Okay. I think this is a really good policy. I hope they extend it. I hope they make it permanent. Okay. Now, speaking of policy and speaking of tax laws, let's talk about Joe Biden's tax plan, because I've done some podcasts on it. And there's a question about what's going to happen. There's a lot of fear, in fact, about Joe Biden's tax plan, because let me tell you some things that he said that he wants to do. Okay. He said he wants to change the estate tax. And he wants to increase it substantially. Okay. I actually did an article for Entrepreneur Magazine, if you can get access to that, illustrating what would happen if he got what he wanted. And I will tell you, it's not pretty for small businesses, because it effectively could amount to a confiscation of many small businesses. Okay. So he wants an estate tax increase. What else does he want? He wants a he wants 2 rate increases. He wants a rate increase on ordinary income greater than 400,000, and a rate increase on capital gain, long-term capital gain, over $1 million. And people look at that and they say, so give it to them. You know, that's rich people. Doesn't matter. Wait a minute. Let's think about this. Now, increasing rates on ordinary income over 400,000. I've got to tell you, it's a tough argument against that. I mean, I'm not in favor of it. I like low taxes, but I'm also, you know, I could see doing that, going from a 37% to a 39.6% rate, the old rate, okay, which is what he said he wants to take it to. Okay, but let's think about the long-term capital gains. You build your business. This is your retirement. You sell it for $2 million. You're going to now pay 40%, 50% if you're in some states, of that back to the government. That's a tougher one, right? That would actually apply a lot more than you think it would, because most people think it's just the rich people on Wall Street. Well, it's not. It's not just people selling, you know, making big stock gains. You know, they bought Bitcoin at $400, that they bought Tesla at $400. It's not just those people. Okay. It is mom and pop who built their business over 40 years. So consider that is, you know, this could apply to a lot more people. What else does he want? Well, he's talked about some other things. He's talked about undoing the 2017 Tax Act. He just said, roll it back. He's talked about corporate tax rates. He's talked about raising those substantially. What else has he talked about? He's talked about some real estate and some oil and gas changes. Now, let's talk about what's likely to happen. Remember that in the Senate, first of all, in the House, it's a majority of 10. That's it. In the Senate, it's not even a majority. It's even with a tiebreaker with Vice President Harris. That's all it is. So I had somebody I was doing a podcast with the other day said, you should call President Manchin. Joe Manchin in West Virginia is a Democratic senator who is very conservative. One senator on the Democrat side, if the Republicans stick together, one Democrat on the one Democrat can say no. Big veto power. You're giving one person a lot of power. Okay, so will they do that? That's the question. What can they get through? Now, on top of that, most tax bills require a 60% vote. There's only one, they can only do one that they can do at 50% plus. Okay, that's a reconciliation bill, and they can only do one of those in a year. They can do one a year, only one. Okay, so they get one bite at the apple. So the question is, if they have one bite at the apple and they have members of Congress who are conservative, what are they going to get? Well, let's just walk through this and let's see what they may get and what they absolutely won't get. They won't get the estate tax increase. I would be shocked if they're able to get that increase. That is a big, whew. Okay, now, does that mean I wouldn't do my estate tax planning? No, it doesn't. I would absolutely be doing that. I think you've got some time on that, though. That's a big ask. That's a really heavy lift for really very little money. Okay. Can they do the corporate rate? Probably not. I'm going to actually go out on a limb and say no to the corporate rate. Can they do the real estate and oil and gas? I don't think I have to go out on a limb to say no. I don't think they can get that one done. Maybe a little thing, but you're not going to lose your 1031 exchanges. I don't even think you're going to lose your bonus depreciation, but you could. What could they get? Could they get this? Yeah, they could get this. Could they get this? Questionable, right? Let me tell you what's more likely. Believe it or not, I think the most likely thing they're going to get, I'm going to put this right up here, state income tax. And that is a decrease in tax. They're going to get, some little things, right? They'll get maybe some retirement plans and stuff like that changed. But this is the big one. Remember, Chuck Schumer, who is now leading the Senate, he's from New York, and Nancy Pelosi is from California. So these two states, big tax rates, their donors pay a lot of state income tax, and they want this deductible. They've been pushing this for 2 years. They've been pushing this. So we might see that. That would be interesting. That would be interesting. We might see that. So we'll see what happens. Are we going to get massive tax increases? Here's what I can tell you. As a general rule, taxes are not going down in the next 2 years. They're not going down. This is why now more than ever, I would make sure I'd had a tax strategy in place, a plan of action in place. I would absolutely make sure I did. So I think you got some time though. Okay. So take the time to sit down with a good CPA, sit down with somebody who, knows how to deal with these items and walk through your situation. And okay, now how do I plan for this? Now, let me tell you the most important thing that I think is in his plan. And it's this number right here, 400,000. For those of you who are old enough to remember, George H.W. Bush lost the election to Bill Clinton over the words, "Read my lips, no more tax." Read my lips. If Joe Biden were to tax people under 400,000, there would be a rebellion. So I actually don't think it's going to happen. I think that's a target. That is a target number 400,000. Every single client we work with, I guarantee you, I am targeting that they do not have taxable income over 400,000. Now, is that legal? It is when you follow the tax law and understand the tax law. So things like the meals, the travel, all of these things we've been talking about, non-taxable PPP loans. I mean, there's thousands of incentives. I do think we're going to get some new incentives. Okay. One of the big new incentives, of course, we're going to get is climate type incentives. So clean energy, we will get more clean energy incentives. So what's going to happen is the incentives may shift, but there's still going to be incentives. So that's, to me, that's the good news is that, for them to, they're not going to simplify the law. That's not going to happen over the next 2 years. And they're not going to be huge tax decreases. Okay. Little things. And there could be some tax increases. I think that he wants to show that he's going to increase taxes. So I certainly think he will try to do this, okay, at a minimum, and they will go after this. Whether they will get it, we'll have to see. But a good tax plan, of course, you can deal with that. If you're an entrepreneur, you should be able to stay under 400,000. So with that, Manny, questions on the Biden tax plan?
One question that we have from Facebook is, does that mean the state tax would go down, or that you can just deduct the state tax on your tax return?
No, it actually probably mean that state taxes would go up. So I know that seems odd, but think about it. If California, so right now, California has a top rate of 13%. They floated a 16% rate. Okay, at 13%, if it's not deductible, you're paying 13%. If it's deductible against 40%, if you get a 40% tax benefit because you're in a 40% tax bracket federally, and you get a deduction for that, now that 13% is more like 8% or about 8%, I think. So, yeah. It's right at 8%. So it's basically like you reduce their tax rates. So now they could raise their taxes more if they feel like they need to or want to. So I don't think state taxes are coming down necessarily. If anything, it's the federal tax that comes down, and state taxes they could actually raise. Now, this would be good news for Arizona because we just did the unthinkable and voted ourselves an 80% tax increase. Don't ask me how that happened. It's very disappointing for those of us living in Arizona. But literally, we went from a 4.5% rate to an 8% rate. If this were deductible, it would effectively come back down to a 6% rate, effective rate. So that would be good news for Arizonans. Again, though, if you keep your numbers low, my guess is you're going to be okay. The key is let's hit that $400,000 or below number. I like to target a 20% tax rate. My goal with every client is 20%. So because if you get below 20%, sometimes it's not worth the lift, right? It's not worth the complexity and the things that you do to get up below 20%. Can you? Yes. Do I have clients that pay no tax? I do legally. But remember that, just think that if you can get your tax rate to 20%, that's a good place to be. That is target number one. Here's target number two right here, 400,000. All right. Other questions, Manny?
We have one from one of our clients. She says that her husband is a W-2 employee and she's working on a real estate apartment business. She's not getting paid by the apartments, so they roll it back to their business. Would she qualify for the PPP loan?
No, PPP loan is strictly for wages. Okay, that's a really good question. She might qualify for the EIDL loan, right? So there's another loan that's not forgivable. It's a really good loan. Okay, it's like a 2% loan for, it's a very long-term loan. I think it's 30 years. And so it's a really favorable terms in the loan. And that is a loan. It's called the emergency income. Oh, the emergency. Anyway, it's the EIDL loan. Sorry, I've lost what the acronym stands for. But the EIDL loan, by the way, there's one other little benefit out of this last stimulus bill. If any of you received the grant, the EIDL grant, it's called the EIDL emergency grant, and it was $1,000 per employee up to $10,000. Originally, under the CARES Act, if you got that grant and you got a PPP loan, you were required to pay back that portion of the PPP loan that's equal to the grant. They eliminated that in this last bill. So if you got the grant, this is, again, I keep telling people, don't give up money. Don't give up free money. Don't do it. I feel pretty strongly about this because we don't know where we are. Here's the deal. On your tax return, you are allowed to donate to the federal government. There's a box you can mark and you can donate to the federal government. If you get this new loan and you say, I don't really need it, you've got two choices. You can just pay it back, don't ask for forgiveness. Or let's say you ask for forgiveness, but then later on you go, you know what? I think the federal government needs this more than I do. You can pay it back on your tax return. So, this is, but the EIDL grant is a good example. I knew a lot of people who said, it's $6,000 or $10,000 and I'm going to have to pay it back. I'm not even going to bother. Those who got the grant, it was forgiven, non-taxable. So just know that, the government giveth and the government taketh away. And, I admit it's a bit of a game. Okay. But remember, what's most important is that your business survives, that your employees have jobs. That is the most important part of what we're talking about here, is that we keep this economy going, that we get as much of a semblance of normality as we can. This isn't about, we're not stealing from the government. We're doing what the government wants us to do. So just recognize that you can always pay the money back. You can always give it back on your tax return. Don't feel like, oh, well, I hate it. I don't like the shaming part of what's been going on. There's a lot of shaming lately over the last year, and I don't like that at all. So, but make your decision, okay? And sit down with your accountant and walk through the numbers. I will look at, and we'll post this. Manny, where could we post things that we can let everybody know?
So right now it's going to be on Facebook, but I know that we're moving to having this entire webinar also on YouTube.
Right. So we're going to do that, but there are a couple of questions that I got stumped on, frankly. So Manny, I presume you're taking notes on those for me. And
yes. And
here's what I'm going to do. I'm just going to do a quick little snippet for YouTube that I'll put it on YouTube. Okay. That's what I'll do, Manny. I'll actually do it tomorrow. I'll put that little snippet on YouTube, say there were a couple of questions that came up during our town hall, and here's the answers to them. So I don't want to leave you guys hanging. Okay. All right. Any other questions, Manny?
We have one that's going to be live, and Travis, you can go ahead and ask your question. Make sure that you unmute yourself.
Travis.
Yes, sir. I was just wondering, if, when, or how often will there be an update for the tax-free wealth book? I know there's been a lot of changes coming, and I just like to stay abreast. Will it be like an update that we can download or anything?
You know what? Anytime we have a significant new tax law, we will update. We reprint it several times a year. Okay, thank you, by the way. We have to reprint it several times a year. So when we reprint it, we do an update. We don't change the edition. There's actually a rule on what's a new edition. So it'll still say second edition, but we can't have updates. The other thing is that we do have, and something that we ought to look at, Manny, is when I do an audio, when I read the audio, I actually refer back to some charts and tables, and they're on our website, and we can even do some updates there, Manny. So if you'll just make a note for me.
Sure.
Thank you for asking that. Thank you for reading it. And we do at least once a year, we do update it.
We have another question from Steven. He says, should I wait to get solar on my home until we get Biden's language?
Really interesting question, because we're at a 26% solar credit right now. And the question is, will Biden increase that? I might wait a little bit. Now, here's the thing. Yeah, I might. That's a really good question. I've thought about that question. I did my solar a couple of years ago when it was still 30%. I did it right before that 30% ended. And I will tell you, I'm a big fan of solar. And I will tell you, it has been great for my electric bills. So a little promotion there of the solar industry, because we had this, I mean, you know, we had 50 days over 110 in Arizona this summer. I know that's going to scare all of you out of Arizona if that 8% tax rate doesn't. The 50 days, we've never had anything close to that. We broke the record by like double. But I'll tell you what, I was sure glad I had solar, because it cut my bill way down. It was well worth it. And then the credit was, yeah, it just means that the government is contributing, right? So you may want to hold off. I will tell you, I probably would. I'd probably hold off a little bit, maybe until, you know, see what happens this first. I think he's going to be really busy with coronavirus and that response personally, but they're trying to get some things done in that first 100 days. They know that that's a big mark for presidents. So if you can wait 100 days, you might want to wait, because here's what happens from a tax bill standpoint. This is why this question is so important. Typically, they don't make tax bills retroactive. Now, I will say that in 2017, they made some of the biggest tax benefits retroactive to September of 2017. So the bonus depreciation was made retroactive to September of 2017. And it was basically retroactive to the day that they first proposed it. So, you know, I would certainly wait past inauguration, wait to see if he proposes something in the first 100 days. After that, I don't know if you really want to wait, but it's a good question. It's something that there are some, you know, when you look at these new incentives that might be coming, how far back will they go? Will they go back to the beginning of the year, which you would love, and they could, or will they start on the day that they enact the bill? Thanks for asking that question.
We have another.
Yes.
Yeah, we have another one for clarification. It's coming from Facebook. Does the 400,000 target mean the amount over 400,000 is taxed incrementally over that amount, or once you hit the 400,000, your total income is taxed at the new bracket?
Really terrific and astute question. So we have what's called a graduated income tax rate. Okay. So what that means is that everybody in the US has a 0% tax bracket, a 10% tax bracket, a 12% tax bracket. We all have these tax brackets. We don't lose the tax bracket. You can be, Warren Buffett has a 10% tax bracket. It's a very small amount, but he's got a 10% tax bracket. Okay, so we're not going to lose that. It's not a cliff. It's not going to be a cliff. Okay, so what it's going to be is that if he raises taxes, presumably, let me give you an example. Here's one that I didn't put up here. One of the honest tax increases that he suggested, I'm going to draw it. is what we call the donut hole. And this is Social Security tax or self-employment tax, same thing. You recall that Social Security that tax is broken down into two pieces. The first is the actual Social Security, and the other is Medicare. And several years ago, the cap was taken off the Medicare piece. So the Medicare piece is anywhere from 2.9% to 3.8%, depending on your income level. Okay, that's the Medicare piece. The Social Security piece is the rest of it, the 12 point. Sorry, I have to add this up. The 12 plus percent, 12.3, 12. I can't remember, 12.3, 12.6. So that's the Social Security piece. So that's the big piece, right? Social Security is the big number. Medicare is a little number. There's no cap on it. We're not talking about Medicare. We're talking about Social Security. Okay. So, 7.6. Hang on a sec. I got to do this math. It's 15.3%, 2.9. So it's 12.4%. So Social Security right now is 12.4%. So basically, what they're saying is it's going to be 12.4% here. And then it's going to be 12.4% here. But in here, so this is right now it'd be about 142 to 400,000. Okay, it's going to be 0. So up to 142, it's 12.4%. Over 400,000, it's 12.4%. But in the middle here, it's 0. Again, this is why you don't want to be over 400,000, because if you get over 400,000, you're everything over that is taxed at 12.4% again. So we're again targeting this number in here. Of course, we'd like it to be even lower, right? I mean, salary would be great if it were 40,000, right? We have to be a little realistic there. There are some things we can do when I talk about a tax-free wealth, but we'd love to be even lower than 142 in the amount that's taxed for Social Security. Because remember, distributions like from an S corporation, they're not subject to Social Security tax. Real estate rents aren't subject to Social Security tax. So there are types of income that aren't subject to this tax at all. Pretty much for the most part, it's all subject to Medicare tax. But this is one of the proposals from Joe Biden is President-elect Biden is this weird donut here where this is taxed at 0 and over is 12.4% and under is 12.4%. So again, $400,000, that's our target. Don't go over and you'll be good. Now that doesn't mean turn down income. We don't turn down cash. What we do is we create a plan so that our taxable income is under 400,000. It is taxable income. What we don't know is if he means 400,000 as a couple or 400,000 as an individual. We don't know any of that. He hasn't actually made specific proposals. So we'll find out. We'll let you know once there's tax proposals. You can guarantee we will do a town hall like this. We will let you know what's going on. That is my commitment to you, that anytime there's major tax legislation, we will do a town hall like this and we'll make sure everybody's on top of what's going on. Manny?
Sure. Another question, or one question from Bijou. He asked, my business was affected in first quarter of 2021. I do not have any income in this quarter. Whether I can apply for a second PPP loan in that case?
Okay, if it's 2021, we're still in the first quarter of 2021. So
maybe he says 2020.
2020. So the first quarter of 2020, so yes. So let's say that you had very little income in 2020, okay, in the first quarter of 2020, but you had income in 2019, you can apply. Now, remember, you have to spend it on employees. 60% must be spent on payroll. You don't get anything if you don't spend 60% on payroll. No forgiveness at all. So you can still get the loan, you just owe the money back. Okay. But remember, if you don't have the employees, you don't get the forgiveness. So this is about employment. Let's be really clear. It's not just, this is not just save the business. This is save the jobs. This is a save the jobs bill. It's not really a save the business bill. Now we need employees to make the business run. But the reality is, if we don't have employees, we're not going to get forgiven.
Back to PPP, when you said PPP is not taxable, does it mean you don't need to add it into your ordinary income, or are you also able to deduct the expense as usual?
Yes, both. So you get no tax on the income, so you don't have to put it in, but the expenses are deductible. It is a win-win. Okay. There's complaints by certain groups that say, well, you're getting a double benefit. Well, yeah, so that we can take care of employees. Okay. Remember, all the money went to employees. It didn't go to, it's not like it went into our pockets as business owners. It went to pay expenses. Now, the fact that those expenses are deductible is what was always intended. I want to be really clear. In the original CARES Act, the intent of Congress clearly was that the forgiveness was not going to be taxable and the expenses would be deductible. Unfortunately, the way they wrote the law, the IRS, I think, had to come out and say, look, if your income's not taxable, then the expenses are not deductible. I think the IRS was actually correct in that assessment. I hate to say that, but I think they were. And they needed to make this change, but they made it really clear. By the way, if you had payments made on your SBA loan, so a lot, and they're doing that again, right? They're extending that they're making the payments for you. That's not taxable either. So there's your EIDL grant, that's not taxable. There's a lot of stuff not taxable, expenses deductible. They did a really good job with the language. The IRS came out just last week and said, absolutely, under the new act, then they actually pulled their previous notice and said it's deductible under the new act.
A quick clarification on the on the energy bill from Biden regarding the oil and gas investment.
Yes.
They ask, because currently passive losses can be offset against ordinary income. You can correct that if that's a wrong statement. So if they are planning on decreasing their taxes this way, should they wait and see whether this passive loss loophole will be available for green energy instead of oil and gas?
So let's talk about that for a second. We'll push my buttons a little bit here. Let's start with, it's not a loophole, okay? A loophole is an unintended consequence, and the oil and gas tax benefits were absolutely intended. They're not passive, okay? That's actually the distinction. So oil and gas, there are two tax benefits when you invest in an oil and gas drilling operation. Two potential benefits. One is what we call IDC. These are intangible drilling costs, and typically are about 80% of your investment. It's everything except the equipment. Everything except the equipment is IDC. Then we have depreciation. That's the equipment. Typically, it's about 20%. What that means is pretty close to 100% of your investment in an oil and gas drilling operation will be deductible, either in the year you invest or the subsequent year, between those 2 years. Now, when you talk about the loophole, okay, let me explain what that means. You don't have to be drilling the well yourself, okay? So you don't have to worry about, can you just make an investment and somebody else does all the work? And the answer is yes. Now, you have to be a general partner. You cannot be a limited partner. You cannot own it through a limited liability company. You must be at risk. That's the trade-off. You must be at risk for whatever goes on. Now, typically what they'll do is buy a huge amount of insurance. I've invested in oil and gas for years and years and years. So I actually went to the University of Texas and took an oil and gas class. I love the energy business. I love the renewable energy business, but frankly, I'm fascinated by the oil and gas business and every other type of natural resource. You have to be a general partner, okay, when you invest. So you're taking on the risk. That's the trade-off. That's what the law says. It's always said that. By the way, the real estate professional rule for real estate came many years after the original law. This came with the original law, primarily because we had a senator that, in Texas that was pretty powerful, and he insisted on this. So you can't offset that against any type of income. So I would not wait. Okay, because again, when they let's say that they said, well, and I don't think this is going to happen, but let's say they said, well, we're no longer going to give you intangible drilling costs, which is what President Obama wanted. Okay, it was in his budget every single year. He wanted to get rid of the intangible drilling cost deduction. Joe Biden has gone back and forth on this. He originally said he was going to shut down fracking, which is, this is how you shut down fracking. Okay, get rid of this. He originally said that, and then he backtracked. Okay, so he said, no, we're not going to shut down fracking. Well, if you eliminate intangible drilling cost deduction, you are shutting down fracking because nobody's going to do it. It's too risky. So we'll see what happens. But here's what I do know has happened. It's very rare that they enact it retroactively. So if you invest today, chances are they're not going to shut that off. They're going to take a point in time and they're going to shut it off at that point in time, but it'll be after the inauguration. It'll be after they actually make the proposal. Okay. It's really rare they go back to the beginning of the year for a tax increase. This is a tax increase. Okay. It's bad tax policy. There's some question whether they can do it at all, whether it's even legal, but it's certainly bad tax policy. So thanks for asking the question, because we don't know what's going to happen with oil and gas.
We have a great question from an anonymous, and they say, if my W-2 income is about 400,000, can you still bring it below 400,000 legally?
Well, this would be one way.
Mm-hmm.
I mean, sure, this would be one way. Absolutely. If you were at $500,000 and you invested $100,000 in oil and gas, you would get a $100,000 deduction. So yes, you could. Now, it's easiest when you're either a professional investor or a business owner. It's easiest if you're either a professional investor or a business owner. It's much more difficult if all of your income comes from W-2 wages. It's not impossible. Here's an example. However, it is much more difficult. Okay.
Another question from Facebook is the CARES Act 5-year carryback going away in 2021, if you know?
Yeah, it was not extended. It was not extended. So that carryback applies to 2020, 2019, and 2018. It was not extended into 2021. Thanks for asking that.
John asks, Can they backdate the capital gains tax change after it is made?
Can they, I'm sorry, say that again?
Sure. Can they backdate the capital gains tax change after it is made?
Can they, they can, maybe. Will they? Probably not, okay? As a general rule, they do not do that. I mean, if you look historically, it's really questionable whether it's legal to do it at all. Okay, make a retroactive change like that, and it's horrible tax policy, just awful. By the way, before we wrap up here, let me throw out one more thing, and that is in the stimulus package in the Budget Act, there were a lot of tax benefits that were extended. Okay, I don't know them all off the top of my head. They're little things here and there. Just know that, you know, we talk about some of the big things. We talk about real estate, and we talk about business, and we talk about energy. There's a lot of little things. So that's the advantage of really sitting down, spending some time with your tax professional, is really going through and looking at, I mean, I've got clients that have historic renovation credits. I have a lot of clients with research and development tax credits. There's a $500 credit for energy efficient things you do to your house. Okay, so there's a lot of little things that people don't think about. Just that's why, you know, you go, well, what if I, you know, how do I reduce my taxes? Well, that's where we come up with a plan of action, because what we really want to do is we want to increase our income and increase our wealth while decreasing our taxes. And what I'm telling you is that is not just possible, but it's something we do every day. And so don't think, remember the tax law, the government actually, it seems odd. The government wants you to be rich. The government wants you to be rich. They want you to be successful. As long as you do what they want you to do, right? They don't want you to go off on your own. They want you to do what they want you to do. And if you do what they want you to do, there's probably a tax incentive to do it. Okay, so just keep that in mind. Probably not retroactive tax changes. One more question, Manny.
Sure. Bill asks if you have any thoughts, or do you know about the return of the ability to deduct primary home mortgage interest?
Oh, so we have, obviously, you know, we can deduct up to $750,000 of a mortgage, right? Interest on up to $750,000 of a loan. It used to be $1 million, it's $1.1 million, and you know, before that was unlimited. Will they increase that? I'd be surprised if they do. Remember, there's just a lot of pressure right now to tax the rich. And they think anybody who makes more than $400,000 is rich. Some people think if you make more than $100,000, you're rich. Okay. I don't. Okay. And I think this is a country of opportunity, and that we ought to be able to make as much money as we want and not be shamed for being successful. Okay. So anyway, that's a little bit of my philosophy on this. Manny, I think we have time for another question.
Sure. We have a question from Jim. He asks, do you think QBI will be eliminated?
Okay, so let me explain what QBI is. That is qualified business income. Qualified business income deduction is a 20% deduction off of business taxable income, business income, okay, on a flow-through entity, like a partnership, sole proprietorship, or an S corporation. Here's your magic number. If they go after, that would be tied to corporate tax rate, okay? If they increase the corporate tax rate, they will go after the qualified business income deduction. However, they will limit it to that $400,000 mark. Okay, I would guess what they'll probably do. So right now there is a limitation if you're a professional service business, like, I don't know, an accountant. So I get limited. Okay, if your income's over a certain level, you're limited. And I think they would just apply that limit, and they would just apply it to all businesses. It's a really easy change to make, really easy change to make. So could it happen? It could. A lot of people would be fighting against it, hopefully, but it's possible. Certainly if they get the corporate rate, they would do that. Because remember, the qualified business income deduction was an effort to benefit the small businesses when they benefited the large businesses with the corporate rate reduction. Remember also though, anybody can be a corporation, right? You don't have to be a pass-through entity. So you could get the 21% rate now. Okay. All right, let's wrap this up, Manny. Look, if you have more questions, if you just want to have some more opportunities to learn about this stuff, thank you so much for joining us, everybody. It's absolutely my pleasure, and I love doing these. Thank you so much for your questions. Wealthability.com has a boatload of information. Like I said, I'm going to do a short little YouTube. This will be posted on YouTube, but I'm also going to do a short little YouTube to answer the questions that I was stumped on. And of course, there's tax-free wealth. So don't forget, this is really kind of the main handbook is tax-free wealth. And let us know if there's more you'd like to see. The Wealthability Show, also free. The podcast, twice a month, we do the Wealthability Show. For those of you who are just really gung-ho, we have the Wealthability for CPA show as well, and you're welcome to listen to it. So with that, I want to thank you, Manny. Thank you so much for handling these questions. Thank you, everybody on my team, for making this happen, and especially thank you. I want to throw out a very special thanks to all of you who are entrepreneurs and investors who've taken responsibility for your own life, your own finances, and your own financial education. Because remember, when we get that financial education, when we take control of our own finances, our own life, we will always make way more money and pay way less tax. Thanks. We'll see you later.